Part 3, stock market update. Let's get right into it. How do I make my returns? Well, I rely really on a good tailwind, and the good tailwind, well, it's been going on since 1950. I've not been born since, I wasn't born in 1950. 2 years, the average positive return is 32%. Positive returns 88.5% of the time. Look at those data sets. Yeah, most of the time I can just sit back and put my bloody feet up. Which I do try and get across to people. They say, you must be incredibly, incredibly busy. And then, of course, if I tell them the truth that I'm not, rather like Warren Buffett, my calendar's empty, then they want to go and do stuff like have meetings. So I like to let them think I am incredibly busy. So be it. My job is really this part, to just try and cut off that, like 2022, and work out when to hold cash, which, as you will know if you follow me, if the moving averages are falling, MACD basically, and it's a daddy bear, you get out. You have to use that once in 7 years. Because the rest of the time, the market just takes care of the returns for myself in my SIP and my ISA. And quite frankly, the way we do it, this I give access to my clients. Now, let me be clear. I would not give access to this database to them if I wasn't using it myself for my son's inheritance and my wife's SIP and my own retirement fund. And as a hedge fund manager, the reason this was created is because data is oil. It is invaluable. It is gold. It is diamonds. Okay, so what's the end goal result? Well, thank you all for watching this. Thank you, Trevor. 30% in 12 months. Well, it's not me who did it. I just showed you how to do it. The clever people in those companies are the ones who did it. Okay. And by the way, it's very easy to open a SIP or ISA. It doesn't have to be Barclays. It could be Hargreaves Lansdown. It could be AJ Bell. I don't mind as long as it's a regulated institution. What I would say to you is you just go online, you open it, you wire some money into it, and then you say, I want to buy £1,000 for argument's sake of Costco or Walmart or whatever else it might be that you want to buy. It's really simple. A SIP is a tax-free envelope, like an ISA. It's a pension. There's laws around it, such as how much you can put in, but 60,000 annually, roughly, is the rule. Now, whenever you choose brokers, and these aren't the only ones, the best thing to do is not you try and work out the fees. The best thing to do is say to them, I want to buy this much stocks. How much are you going to charge me? How much are you going to charge me? How much are you going to charge me? The thing I'd say to watch out for is, in the SIP, for an interactive investor, they don't change your money back and forth from US dollars to pounds each time you sell something. The others do. So you won't get hit by the Forex charge. And by the way, that's not accurate because read the disclosure. There are caps on these things. So free trade isn't necessarily the cheapest. Just have a look and ask your broker, whichever ones you use, and there are others besides these. Okay. When I do this stock market update, one of the things that worries me about people is this. Workplace pensions lost 1/5 of their value. Yeah, that's your pension. And the reason that's happened is because you've not pulled your finger out. Now, they're going to tax pensions as part of your estate in inheritance tax under the budget. So you've basically lost, what's the inheritance tax rate? Well, you've basically lost almost half your pension now going forward. Well, as not you, your children, or whatever's going to be left for them. So let me just work out what that bloody rate is. What is the threshold for 40%? I was worried it was, and it really is. So 40% of your money after the threshold will count towards your estate, the taxable amount on inheritance tax. So you're basically your pension. If you're going to leave a large chunk of it to your kids or whoever, your spouse, it's going to get knocked off by 40%. I've just got to check whether your estate into spousal transfer. Somewhere in my brain it tells me that are exempt, but I might be wrong. Okay, so you need to know about that. That's before you lose 1/5 of the value because the Muppets in your workplace pension have decided to put the money into bonds, which they thought was safe and didn't realise that the price of bonds can fall, as they are doing at the moment. So there's a lot of pensions out there which have been put in the cautious thing, but since this budget, the British government said we're going to issue a lot more debt, which means a supply of greater bonds, more bonds. If the supply of something increases, the price drops. Therefore, in the case of bonds, the yield, interest rate goes up. However, the price of those bonds in the books are going to have dropped, which means your pension's not going to look as good as it did. You really have been screwed this week on your pensions, by the way. Anger grows over these awful pension savers. So if you're with Morrison's, Marks and Spencer's, Whitmer, Scott, just be careful, because the pension managers are screwing you over, which is why the Financial Times has said, give workers power to ditch pension schemes. That's the FT. At the other end of the political spectrum, the Guardian, pensions, why do those retiring face massive losses despite FTSE highs? Yeah, partly because people are led to believe that safe pensions in bonds mean that you just get an interest rate. You've locked in, it's like a fixed term deposit. Well, it is if you're holding those pensions yield to maturity, then it can be. But if you're not, and they're marking it to market, then you're screwed. And basically the problem, what I'm saying is, which we try and avoid with our clients, is this. It's not bespoke. The fund manager, the IFA says, oh, it's bespoke to you, Mr. Patel. I'm speaking to you one-to-one. Yeah, but you're shoving me in a fund which has 5,000 different kinds of clients in there. So it's not actually bespoke. Bespoke would mean that, right, this is your specific risk appetite. Therefore, this is the specific investment for you. Not, here's a fund, a bunch of other people I've sold it to as well. These are the sectors and how they've performed. I don't gamble, as you know, on sectors because it'd be like gambling on horses and who's going to win. What I do is look at the underlying companies, and if the companies are healthy, then there should be a lot of them in the sectors which are doing the best. Okay, what I look at in particular are factors. As you will know, I look at companies with momentum, companies with value, which is that one, companies with growth. Okay, so what happens? By picking a subset of a subset of a subset, we've filtered so much for quality by making sure we've got greens across the board that we should have checked every important piece of information according to those Nobel Prize winners, and we should have companies which do rather well and capture a lot of that index gain and beyond, because we're cherry picking out of the index. Markets over the past year, well, your pension should be up nearly 50% then, 44%. If your pension isn't up 44%, ask your IFA or wealth manager, show him this, and say, Alpesh is asking why you're an idiot. And the reason I say that is because, as I said, they're going to talk to you about volatility. Can you see the volatility here? I think you could take that, couldn't you? If I told you very simply, yes, there are periods where it goes up and then comes back down. There are periods why we look at 12 months and not just that. Then the arguments your IFA and wealth manager is going to make, and I'll tell you exactly what they're going to say to you. Yes, but the fund manager we've put it in is awfully clever. We've got some of this American stuff. Yeah, they've got way too little, so you're not getting any gains. In any event, if you put too much in, eggs in one basket, well, America is actually the most diversified global market in the world. I'm not saying you only have to have American stocks. You could have British ones as well. I'm not stopping you. But the point being is I'm telling you the bullshit excuses they're going to make because they've got 20% VAT on school fees coming in. They've got to send their kids, well, you've got to send your IFA's kids to private school. And if you want to continue doing that, continue using those Muppets. But instead, the government created SIPs so that you could empower yourself. These are the top 10 FTSE 350 rises over the past month. Okay, there they are. I'm not going to go into this because I want to go into this. The S&P 500, if it were to continue this trend, there's no guarantee, and that's the most bullish case. Most bullish, I don't think that'll happen in the next 12 months, but that's the most bullish case. Where we are, and this is a measure of the short and medium term moving averages shown by that, the MACD. Monthly is the blue dotted line. It is very similar to where we were around this time. So I've got the S&P since January of 2023, since then, as you will know, and 3 times leverage. Would I buy more today? Well, probably not if I didn't own it. Should you? Well, if you're risk loving, yes. If you're risk averse, no. I don't know what the future holds, but given that that's what it looked like there, you might think, or you might go halfway house, which is the risk neutral way, and say, I'll average in. In other words, I won't buy the whole, whatever, £10,000 worth. I'll buy 3,000, 3,000, 3,000, or Canadian dollars or US dollars. I've got clients from around the world. The reason I want to show you this is in 2022 when the markets fell, nothing will save you. Your fund manager, your IFA, your wealth manager will say, oh no, don't worry, ask them, how did we do in 2022? And I'll guarantee you they stank because they couldn't hold cash. Now, I didn't know 2022 was going to be a bad year. I knew in January I want to wait till the February list came out of stocks to pick, and then February I knew March because the moving averages were dropping on the MACD, which is a rule I have, I've mentioned in my books and ever elsewhere. So that's not new, none of those things save you other than cash, i.e. being out of the market. But your IFA wealth manager will say, oh, no, we just move things around, because they can't hold cash. So they'll be lying little so-and-sos by burying that in the small print. NASDAQ, where are we? Very similar to the S&P. I continue holding it since January 2023 and fine with it. That's where it is. Phenomenal returns. Essentially, you've gone from 250, you've gone up 100% since 2023. And if you're 3 times leverage, you've in an ETF like we were, you've roughly gone up 150%. And that's an index. You get mama bears like that, baby bears like that. What are those? Well, you can ignore them. You can ignore those falls. And we know to ignore them, because if the MACD is, i.e. the moving averages are rising, you ignore any price falls. If they're falling, you ignore price falls, unless it is that scenario overbought at the top end of the graph, falls below its own moving average. What I call a daddy bear happens once in 7 years. Okay, simple. Part 4 will also be along shortly. Do keep an eye out for it. Do like and follow. Do have a look at alpeshpatel.com/links. Message me, comment, tell me if you're liking this the way it is. If you don't comment, then I'll stop doing them. Thank you very much.